Welcome to our weekly market and portfolio review for September 27th, 2025. I'm here to break down what's been a fascinating week where Federal Reserve policy accommodation collided head on with Washington political dysfunction. We'll explore how this unique dynamic shaped market performance and what it means for investors going forward. This week perfectly captured the complexity of modern markets. On one hand, we had the Federal Reserve cutting interest rates for the first time in 9 months, which should have been a tailwind for risk assets. But simultaneously, we saw escalating political brinkmanship in Washington with government shutdown threats. This created a tug of war between monetary policy optimism and fiscal policy uncertainty that defined market behavior throughout the week. Three key forces shaped market dynamics this week. First, the Fed's rate cut provided that supportive backdrop investors have been hoping for. However, the looming threat of a U.S. government shutdown significantly tempered that optimism. Adding to the complexity, we saw continued unpredictability in trade policy that created additional layers of uncertainty for market participants. When the dust settled, major indices finished with modest losses, reflecting that investor caution ultimately won out over Fed enthusiasm. The S&P 500 ETF declined 0.3%. Technology stocks were hit harder, with QQQ falling 0.6%. And small caps showed their typical sensitivity to uncertainty, with IWM dropping 0.7%. This performance pattern tells us that markets were more focused on immediate political risks than longer-term monetary policy benefits. Despite this week's pullback, the year-to-date story remains one of large-cap growth dominance. QQQ is still up an impressive amount year-to-date, followed by SPY, with small-cap IWM lagging significantly. However, this week's performance pattern suggests we might be seeing the early stages of a defensive shift in market leadership. Let's look at the week's standout performers. Lithium Americas absolutely exploded higher by 94.8% on reports of potential government investment. Intel jumped 20% on speculation about Apple investment, while Teradyne gained 12.9% following analyst upgrades. IBM also saw solid gains of 6.7% related to quantum computing developments. These moves show that individual stock stories can still drive significant outperformance even in a challenging market environment. On the flip side, several stocks faced significant headwinds. CarMax was the week's worst performer, plummeting 23.2% after disappointing Q2 sales and profits that fell well short of expectations. Housing-related names like Builders FirstSource dropped 4.8% as builder confidence hit concerning lows. Even Jabil, despite beating forecasts, fell 3.8% due to automotive sector pressures. These declines highlight how sector-specific challenges can override broader market trends. Perhaps the most important story of the week was the clear defensive rotation we observed in S&P 500 sector performance. Investors were clearly weighing shutdown implications more heavily than Fed rate cuts, leading to a notable shift toward defensive positioning. This rotation tells us a lot about current market psychology and risk appetite. Energy and utilities led the market this week, and for good reasons. Energy benefited from attractive valuations and its status as an inflation hedge, with a forward PEG ratio of 1.66, suggesting the sector remains inexpensive relative to growth prospects. Utilities found support as investors sought refuge from potential market volatility amid the policy uncertainty we've been discussing. The laggards tell an equally important story. Healthcare faced immediate pressure after the 100% pharmaceutical import tariff announcement. Financials hit all-time highs on Tuesday, but then pulled back on profit-taking. Technology saw modest declines, which is consistent with expensive valuations and the risk-off sentiment that dominated later in the week. The market's pivot away from growth sectors toward defensive and value-oriented areas sends a clear message about investor priorities. Market participants are demonstrably more concerned with immediate fiscal shock risk than they are optimistic about monetary easing. This sentiment shift is crucial for understanding current market dynamics and positioning. Beyond the headline numbers, several developments caught our attention. Cybersecurity conferences in St. Louis and Krakow underscored persistent digital threats, reinforcing the secular growth thesis for cybersecurity infrastructure. Meanwhile, Shanghai's World Design Capital Conference highlighted design's increasing role in empowering industries, which is particularly relevant for luxury brands like LVMH. Analyst activity was particularly busy this week. Tesla saw multiple upgrades, with Wedbush raising their target to $600, citing an accelerated AI path, while Mizuho increased to $450, noting U.S. EV leadership. Apple also benefited from Wedbush lifting their target to $310 following strong iPhone 17 demand signals. General Motors got an upgrade from UBS to buy with an $81 target, showing confidence in their strategic turnaround. This brings us to the week's central theme, the collision of monetary policy accommodation with fiscal policy dysfunction. This unusual dynamic created the crosscurrents that defined market behavior and will likely continue to influence trading in the weeks ahead. Let's establish the timeline. The week began on Sunday, September 21st, with a new $100,000 H-1B visa fee taking effect, creating uncertainty for tech sector talent sourcing. The week concluded Friday with personal income up 0.4%, spending up 0.6%, and core PCE at 0.2% monthly and 2.9% yearly, showing that inflation pressures aren't accelerating significantly. The Fed's actions were notable on multiple fronts. First, they cut rates by 25 basis points to the 4.00 to 4.25% range, marking the first cut since December 2024. Their official statement acknowledged that downside risks to employment have risen, signaling a clear shift in focus. Perhaps most importantly, the dot plot revealed that the median member anticipates 2 additional quarter-point cuts by the end of 2025. On the fiscal side, the situation was far more concerning. The White House OMB directed federal agencies to prepare not just for temporary furloughs, but for permanent mass layoffs, targeting programs not aligned with administration priorities. This represents a significant escalation beyond typical shutdown preparations and helps explain why markets reacted so negatively to these developments. The potential consequences extend well beyond politics. A BLS shutdown would cease operations, putting the monthly employment situation summary at risk. This creates a problematic situation for the Fed, whose data-dependent policy decisions would be compromised. The market impact could include increased probability of policy errors and heightened volatility. International developments added another layer of complexity. Trump's address reiterated America First policies and criticized globalist institutions. We saw allied divergence as the UK, France, Canada, and Australia recognized Palestinian statehood despite U.S. and Israeli opposition. China made a surprising move with Premier Li Qiang announcing voluntary relinquishment of developing country status to bolster the WTO system. Trade policy continued to evolve with new 100% tariffs on imported pharmaceuticals, along with levies on heavy trucks and furniture. China's retaliation continued with an effective boycott of U.S. soybeans, inflicting economic pain on American farmers. This ongoing trade tension adds another layer of uncertainty for businesses and investors. Here's the key contradiction that markets are grappling with. The executive branch's tariff and visa fee strategy is inherently inflationary, putting administration goals at direct odds with the Federal Reserve's price stability mandate. This policy paradox creates a challenging environment for both monetary policy and market participants. Looking ahead to September 29th through October 3rd, market direction will likely be determined by two critical factors: government funding resolution and the September jobs report. These events will set the tone for how markets interpret the current policy environment. Here's what to watch. Monday brings the Dallas Fed Manufacturing Index. Tuesday is crucial with the government funding deadline, consumer confidence, JOLTS job openings, and Nike earnings. Wednesday features the ISM Manufacturing PMI, and Friday delivers the week's main event with the September Employment Situation Report. I see three potential scenarios playing out. The bull case involves a last-minute continuing resolution and a Goldilocks jobs report that justifies Fed dovishness without signaling recession. The base case expects a brief politically charged shutdown, with market focus shifting to Friday's jobs report. The bear case involves a government shutdown with permanent layoffs and a weak jobs report that confirms rapid labor market cooling and recession fears. Now let's turn to our portfolio performance. The value-aligned portfolio declined 0.5% for the week ending September 26th, compared to the S&P 500's 0.3% decline. Year-to-date, our portfolio is up 12.1% versus the benchmark's 14.5% return. Let me dive deeper into Diamondback Energy, our top performer. This independent oil and gas company is focused on Permian Basin exploration and production in West Texas. Our investment thesis centers on them being a best-in-class operator in North America's most prolific oil basin, positioned for substantial free cash flow generation through commodity cycles. Apple continues to demonstrate the strength of its ecosystem. Strong iPhone 17 initial demand, unwavering customer loyalty, formidable ecosystem strength, high-margin services growth, and continuous innovation all support our long-term investment thesis, despite short-term market volatility. Policy announcements largely impacted our underperformers. Novo Nordisk fell 9.43% on the pharmaceutical tariff uncertainty despite their strong GLP-1 pipeline. Amazon dropped 5.05% amid concerns over prime practices in the FTC trial. Installed building products declined 4.02% on macro fears despite record Q2 results. S&P Global and Eli Lilly also faced headwinds from sector-specific challenges. The 100% pharmaceutical import tariff represents a clear example of political risk impacting fundamentally strong companies. While this creates near-term uncertainty for our pharmaceutical holdings, the long-term investment thesis for GLP-1 therapies remains unchanged. However, the tariff situation requires close monitoring as it develops. Amazon faces FTC allegations of deceptive practices in prime enrollment and intentionally difficult cancellation processes. While this creates near-term uncertainty, the secular growth drivers of cloud computing and e-commerce remain intact, with analyst consensus suggesting 20% plus upside potential. Installed building products weakness should be viewed as short-term market noise. The long-term fundamentals of the U.S. housing market remain strong, supported by persistent structural undersupply. This creates opportunities for well-positioned companies in the housing value chain. Our current investment approach emphasizes three key themes. First, focus on high-quality companies with durable business models that can navigate uncertainty. Second, defensive positioning as markets show preference for defensive and value-oriented sectors. Third, maintaining a long-term perspective focused on secular growth drivers while navigating short-term volatility. In conclusion, the collision of accommodative monetary policy and restrictive fiscal policy creates a complex environment requiring careful navigation of both opportunities and risks. While short-term volatility is likely to continue, maintaining focus on quality companies with strong fundamentals and defensive characteristics should serve investors well in this environment. Thank you for watching this week's market and portfolio review. Please subscribe to weekly updates and feel free to leave comments with any questions about our analysis or investment approach. Until next week, stay informed and stay invested responsibly.